Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Are you a new or sophisticated investor wanting to learn how to operate a successful syndication business? For life-changing training from the nation's leading syndication expert, my friend Vinny Chopra has the training you need. Text LEARN, L-E-A-R-N, to 474747. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Brian Burke. Thanks for being on the show again, Brian.
Yeah, thanks for having me.
Yeah, I'm pleased to have Brian back on the show. He's definitely an expert in the real estate syndication field. And if you want to go back and listen to a previous show that he was on, it was show number WS23, where we talked a lot more about how he got into this business and his background, but a little bit about him. He's the president and CEO of Praxis Capital Incorporated, a vertically integrated real estate, private equity real estate firm. He's acquired over 700 properties, including over 2,000 multifamily units with the assistance of proprietary software that he wrote himself. Brian, is there anything else you'd like to tell the listeners about is your background and to get us started? And then we're going to jump into this question that everybody has. I've had it so many times just about structuring deals and why we structure deals a specific way. But anything specific you'd like to tell the listener about just what you're up to right now?
Well, what we're up to right now basically is just buying more apartment buildings. And, that's the core of our business is multifamily. And we'll by next week, we'll have closed on 539 units this year. And hopefully we'll find a way to squeak out another, 400, 500, 600 before the year's over and see if we can get a comma behind us this year.
That's a great goal. I love that. You need a comma this year.
Have a comma. You want commas on checks and commas on unit counts. Actually, 2 commas on checks is even better.
Those are nice. It's all right, Brian. So, I get the question all the time, about structuring deals, and people want me to ask more about structuring deals. I know you're the expert. You've had so much experience, in this space. And so get us started and, ways that we should be thinking about structuring deals and, why we would structure them, one way or over the other, and maybe some examples of how you've structured deals in the past.
Well, deal structure is a very complicated topic. There's a lot of different ways you can structure deals, and it really depends a lot on the circumstances. I mean, the most simple way to structure a deal is just a simple profit split. And this goes back to, the age-old, the age-old thing where you go, all right, I'll do all the work, you put up all the money, and we'll split the profits, right? I mean, that's something that's been going on forever, and that's the simplest way you can structure a deal. The simplicity, though, kind of ends right there. As you get into bigger deals, more complicated deals, longer deals, there's so many different things that come into play that will influence deal structure that there becomes almost an infinite number of ways to do it. But primarily, there's really 3 different ways to structure a deal that are most common. The first would be your simple profit split, like we just talked about. The second way would be a preferred return and then a split of whatever's left over after the preferred return. And then the next one would be a multi-tiered waterfall where you have a preferred return and then a split until you reach another return and then a split until you reach another return and so on for as many levels as you want or need. Those 3 main ways are the ways that you would do a structure.
Okay, so we got just a regular profit split, and a regular profit split, like you're referring to, would I guess usually be like a JV deal, right? You wouldn't really syndicate something probably on that level, correct?
Yeah, you likely wouldn't, although it is possible, and I've done it. It's most applicable to where we've done is in like a house flipping fund, where we're gonna put together some money, we're gonna buy houses, fix them up, and resell them, and the profits from each deal are just basically split between an investor or a group of investors and the sponsor who's doing all the work. And it fits well in a structure like that, because you're always turning over properties, you're buying, you're selling, and that stuff is happening rather quickly. You're generating profits on a fairly consistent basis that are significant profits, and you're doing a lot of work. It's, flipping houses is a day job, really. It's not, a set it and forget it kind of a business. So you're always working, and, as a sponsor, you always need to be getting paid. And as an investor, you want to get paid as houses sell and that sort of thing. So a profit split works really well for those type of investments. It does not work well when you're doing something where, okay, let's raise, $5 or $10 million. We're going to buy a $10 or $20 million apartment building. We're going to spend some time in the early portion of the period to fix it up and increase rents. And then we're going to drive revenue and, wait 2 or 3 years and then sell. The straight profit split just doesn't work in that scenario.
Okay. And the most common scenario probably in this industry is the second one you mentioned, correct? The preferred return, then a split after the pref. Is that correct?
I think the last two are equally common. It just depends on the sponsor. So you'll see a lot of kind of single tier waterfalls where you've got pref and one split, and then you'll see a lot of multi-tier waterfalls where you have a pref and then multiple hurdle splits. And that's how we do ours. We generally will have multiple hurdles, although we've done deals in the past where we had just a single hurdle split. So you can see it done both ways. And
so, why, or I guess go into the split a little bit in case somebody's listening and haven't, doesn't know what we're talking about. So they have a preferred return, the investor's getting that amount, before anybody else is paid, right? But then, that split afterwards, elaborate on that a little bit.
Yeah, so the split is just a division of profits after the preferred return hurdle has been met. And so let's first define what a preferred return is, and then we can get into how the split works, because you kind of have to really understand the preferred return in order to understand the split. So a preferred return is essentially, some people think it's like interest on your money. Some people think it's a guaranteed, check that you get every month or every quarter. And it's neither of those. A preferred return means that you're first in line to receive cash flow. So you get, as an investor, if you're an investor in a deal, let's say you have an 8% preferred return, which is pretty common. Mm-hmm. And what would happen is, if there's any cash to distribute at all, you will get all of it until such time as you've received an 8% return on your capital. Now, there's a lot of different ways you can make a preferred return work, and I've seen it done a lot of different ways. You can have it be cumulative, which means that, let's say we actually distribute 4% in the first year. We would have to distribute 12% in the second year to make it whole. And if we didn't, whatever the shortfall was carries over into the third year and so on. So any amount below the preferred return hurdle that doesn't get distributed accumulates and carries over to the next year. That's a cumulative preferred return. You can also have a non-cumulative preferred return where you get 100% of the cash flow up to 8%, but every year it just resets back to zero, and whatever wasn't distributed does not accumulate to the next year. That's pretty uncommon, but it is out there. And then so you can.
How would an investor know that? And so, that'd be a good question for them to ask that sponsor, right? And so where would they find that, and how would they know that if it was not a cumulative return?
Yeah, you're right. It's a great question to ask, and you can get the answer from the sponsor, and you can also get the answer from the operating agreement. So one of the documents in any real estate syndication is an operating agreement. That agreement governs the entire relationship between the investor and the sponsors. And in the waterfall distribution section, the part that talks about how cash flows to be distributed, it's either going to say there, or there's going to be a term in the preferred return that has capitalized first letters, which means that term is defined somewhere in the agreement. Like, let's say that it says until the investors reach an 8% annualized rate of return, they get 100% of the profits. An annualized rate of return is capitalized. If you see that, that's telling you to go look somewhere else in the operating agreement for the definition for the term annualized rate of return. And in that definition, it should say whether it's cumulative or non-cumulative. The other thing you want to look for is if it's compounding or non-compounding. So in other words, if there's let's say that 4% carries over until the following year, do you earn preferred return on the undistributed 4% as well as on your capital? So there's a lot of different ways that preferred returns can work. There's nuances in it, but in the simplest terms, a preferred return means you get 100% of the cash flow until you've received an 8% return on your money. Once you've reached that level, then whatever cash is left over drops to the next tier, and that's where that split comes into play.
So that split, what's going to happen at the split, and how do we decide where that split should be? Most of us here, I'm sure, 70-30 split or 80-20. What's going to be the most common and why?
Yeah, there's most common, I'll give you a range for most common, is somewhere between 70% and 80% to the investor. And it just really depends. I've seen splits as low as 50-50 after a pref. I've seen splits as high as 90-10 after a pref. It really depends on a lot of factors. And generally, people always think, oh, 90-10, that's better. I want that. I'm going to invest in that deal because that's a 90-10 split and the other guy's is an 80-20 split. And I've seen that happen, but there's more to deal structure than just splits. There's also fees. And so I've seen 90-10 splits, but with a 1% asset management fee calculated off of property value, which, on a $20 million building, you could be talking $200,000 a year asset management fee. So giving a 90-10 split is probably a lot more appropriate than an 80-20 split when the other guy's offering an 80-20 split with a 1% asset management fee calculated on collected income. So, you have to really look at all the nuances of fees and splits before making a decision that one structure is better than another, because everything influences everything else.
So that's some great information there. Really taking in the whole picture, right? Not just seeing the split or how much you think you are getting in return. Taking in, what the investors or what the deal sponsors claiming in fees and charging. So what are some other nuances or things that we need to understand about a split exactly? Or like the 50, why would we, as a sponsor, the 50-50 versus a 70-30? When are you going to do a 50-50?
So we've done 50-50s on like a home building fund, where we're building houses, very labor intensive. The general contractor is part of the GP group and isn't taking a general contracting fee or profit and overhead out of the deal. He's only being compensated from a split of the profits. So a 50-50 split works really well there. It works really well in a house flipping fund. At the bottom of the real estate market, we did a buy and hold fund where we were buying single family homes to hold as rentals after the foreclosures in California. And we created a large fund, and that was a straight 70-30 split, 70% to the investor, 30% to us, with no preferred return. Multifamily side, we're generally going to start at like a 70-30 after an 8 pref. And then some deals, though, we've done have been 80-20s over an 8 pref. And really, it really depends on, what are the returns of the deal? What's the cash flow of the deal? And it's funny because people will call and ask, like, I want to learn more about, your offerings. What are your splits and fees? As if that's really the first question you should be asking. It's really probably the last question you should be asking, because you want to know a lot more about the sponsor than what they're charging. But nevertheless, there's no like menu that you can say, oh, here's our splits and fees on every deal, because it just doesn't work that way. Some deals produce more cash flow, some produce less, some have more back-end depreciation, some it's less. And so what we're doing is we're crafting the splits and fees to back into the returns that we need to generate to make our investors interested. So what you should, if you're the sponsor, what you should charge in splits and fees depends on supply and demand and the cash flow of the deal. Let's break those two into two separate pieces. And let's start with the cash flow of the deal. You have to model the deal out and determine what's available to even be split before you can decide how much you can take, because now you're backing into a return. And then the second piece is the supply and demand. And what I mean by that is, how many investors do you have wanting to fund your deal, and how much money do you need? And if you've got a lot more investors than you need for money, then you can command a premium. But if you're trying to attract investors and you need to raise $10 million and you only know 5 people, and those 5 people only have $100,000 each, and now that means you got to go meet a lot of people and get them interested in your deal, you're probably going to have to offer a richer deal to those investors to attract them. The other piece of the puzzle, which I guess is the third piece I didn't mention, is it depends a lot on the sponsor's track record and capacity and length in business and experience and all those other things. Because if this is your first deal, you're probably going to have to offer investors a different menu of splits and fees than someone who's on their 700th deal.
Yeah, so I liked how you talked about you're gonna set it up and you're gonna back your way into that as far as figuring out what you can offer investors and what really your goal there, right? Your goal to be able to offer investors so they're interested, and then your experience. And if you're more experienced, you're already going to have that track record with your investors as well, right?
Yeah.
So as opposed to being somebody brand new and you're meeting these investors for the first time, they've never invested with you before.
Yeah, you don't know what they're expecting. You don't know what rate of return is going to get them to say they'll do that deal. And really, there should be no rate of return that gets somebody to say yes. And really, there isn't. People say yes because they trust you. So if it's your very first deal, before you even think about what rate of return do I need to get to attract investors, you should instead be thinking, how do I bring people up that trust curve? How do I get someone that's never met me before to trust me with $100,000 or $250,000 or $1 million of their hard-earned money that they value a lot? How do I get them to trust me that I'm not going to screw that up and lose it? And if it's your first deal, that's a very, very difficult trust curve to climb. And it's one of the reasons why I always say, don't think you have to go straight to the big leagues. It's okay to do a $100,000 house flip deal with an investor to get them to trust that you're not going to screw it up, and then build your way up to doing $10 million deals. I've been doing this for 30 years, and trust me, I didn't cross the 2 comma mark for at least a decade of being in this business. So it takes a long time to build that trust up, and a split isn't going to do it.
So, what about, waterfall? Let's move into the waterfall structure a little bit and what that is.
So the waterfall and really the term waterfall really applies to any of these different deal structures. So basically what you're looking at is the cash generated by the project. That goes into the top of a waterfall, and then from that point forward, what happens to it is all your deal structure. So we've talked about just splitting it with someone. We've talked about having a preferred return, and then everything above that preferred return gets split. The next level of complexity is where you have multiple split tiers. So this might work like this. I'll say it quickly, and then we'll break it down. Let's say you do an 8 pref followed by a 70-30 to a 12, followed by a 60-40 to a 15, followed by a 50-50 thereafter. Now what that means is, first step is you have your 8% preferred return. We already talked about how that works. Investors get 100% of the cash flow until they reach 8%. Then the next step is 70-30 to a 12. And the way this works is after you've paid out the 8%, the cash that's left, now forget, let's say you had 100,000 and 50,000 of it went to paying an 8% preferred return. There's another 50,000 left. That's what we're talking about here. That money after the preferred return has been paid, that drops to the next tier. So in the next tier, we're doing a 70-30 to a 12. So what you first have to be able to do is you have to track how much does it take to bring the investor to a 12% return. And then you back into that and say they get 70% of the cash flow that was left over until they hit that number, and the sponsor gets 30%. Once the investor has reached that 12% return and the investor got their 30% piece, now the next thing that happens is The rest of that cash, so now we started with 50. Now let's say we've got 30,000 left. That next 30,000 drops to the next tier, and you get 60%. The investor gets 60% of that until they reach a 15% rate of return. So let's say that eats up another, 20,000. So, I forget how much we have left now, 10,000. See, that's why I use spreadsheets. So whatever's left after that has taken place drops to the final tier, and that's a 50-50 tier. So you split that half and half. That's how it works.
So, and why would we do that as opposed to, that just 70-30 with 8 pref like we talked about earlier?
To confuse people.
That's what it seems like.
Yeah, it does. And people think that sometimes too. That's not actually why you do it. So the theory behind it is essentially, let's say that we think that this deal is going to be a grand slam, right? That's our opinion. We think we're going to do really, really well on this deal. But to do so, it's going to require a lot of work from us as a sponsor. But we think we can get it to the finish line. So what we want is, we want to be rewarded for all that extra effort and for all that hard work of bringing this thing all the way home. However, if the deal doesn't do as good as we think, then we should be rewarded less. So you get more of the profits as an investor if we don't perform as well. So the theory is if the deal only throws off an 8% return, the investor gets all of it and we as the sponsor get nothing. If it throws off a 12, then the investor got an 8% pref, then we split 70-30, that incremental piece of cash that happened between the 8 and the 12, that 4%, we split that 70-30. But boy, if the deal does like a 25, we want to get, a 70-30 split you would deliver the sponsor or the investor would get like a 20% return, and we'd get, this much, this little amount for all that we did and all that success we created. We could get rewarded more heavily for that, for what we produced. So the multi-tier waterfall allows us to participate in a greater way as the performance increases, and in a lesser way as the performance decreases. So it's a bit incentive and it's a bit reward.
And when would you see this? Like per what type of class of property, or maybe a development versus a Class C property, or when would you see that per class?
We do it on most of ours, Class A, B, and C. We've done it on all. We've done it on A deals, B deals, and C deals. Development deals, not so much. Usually we'll just stick to a straight split on a development deal, but there's certainly no reason why you couldn't do that on a development deal as well. So it really applies to anything where, you feel that you have the potential to really bring it home.
Okay. So it wouldn't matter a class. It wouldn't, if we had this Class C and we were going to just really bring it up to a B or anything like that, it could be, you're going to decide that as you back into the deal, right? When you're underwriting it.
Yeah. When we're, for us, I know that if we can deliver to our investors a 14% internal rate of return, that our investors will absorb that all day long. So when we're looking at the cash flow coming out of the property and the exit proceeds and everything, if it's a 20% return net to the investor, then we know we could participate in a greater way, and we could participate in more of the profits as that return is increased, because we really don't need to offer anything that high. And in fact, if we did, people would probably be afraid of the deal because they're like, well, oh my gosh, it's 20% return, it must be high risk. So we always are trying to solve for that kind of mid-teens return range. Now, again, this is supply and demand of capital, and we've been doing this a long time. We have a very broad investor base. If you don't have that, and you really need to, if you need to produce a 17 or 18% return to get your investors interested, then this multi-tiered waterfall might not be a fit for that particular case.
And what kind of investor feedback do you get, per waterfall versus regular split, or other type of structure?
It's funny. Initially, when you show them the multi-tiered waterfall, it's a little bit of the deer in headlights look. So what we spend a lot of time explaining exactly how it works, walking people through it, and showing them, this is how the whole thing how A leads to B, which leads to C. It's all about investor education, just like anything else. It's kind of like, why would you use a floating rate loan over a fixed rate loan? When you're going to do a 3-year hold, why not get a 10-year fixed rate debt? Well, it's because there's yield maintenance and you'll have to pay $2 million to get out of the loan. That's all part of investor education and educating people, why this makes sense. And once you do that, we haven't had any issue with it at all.
Is a waterfall something you were doing early in your syndication career?
Well, early in my syndication career, I was doing the straight profit split. The next ones I was doing was preferred return with a single hurdle. And it wasn't until later on, we'd probably done a few hundred deals, a lot of single family stuff. But on the multifamily side, we had done a few deals before we started in the multi-tiered waterfall. We didn't go straight to it.
Any common problems that people make that, you see them structuring deals and you think, why didn't they do it this way? Or they should have thought about this.
Oh, geez, you see that all the time. And usually it's like, what were they thinking? Why are they doing that? And gosh, there's so many, but mostly it relates to the underwriting side. It's usually the cash going into the waterfall that's the bigger problem, not as much the cash coming out. The structure really just depends on the appetite of your investors and what net return you're going to deliver to them. The trouble with a waterfall is it's just like a computer. It's garbage in, garbage out. So if the cash flows going into the waterfall are fundamentally flawed because of bad underwriting, then no amount of deal structure is going to save you from that. And you can't structure your way out of it. But assuming that the cash flows going into the waterfall are solid, you can do absolutely anything you want with the waterfall, because this is the part where it's not about underwriting a deal. This is all about a negotiation or a mutual agreement between you and your investors. And if your investors are rejecting your proposed waterfall splits because they think it's too rich to you, the negotiation isn't going well for you as a sponsor, and you need to enrich in it, or the investors aren't going to invest. So it's really it's all about coming to common ground with your investors and making sure everybody's getting what they want out of the deal. Nobody's getting overly fat. No one's taking advantage of either side, but it's fair to everyone. And that's the beauty of these multi-tiered waterfalls. It's fair to everyone. If the deal does really well because you do a really good job as a sponsor, you'll get heavily rewarded. If you do a bad job as a sponsor, the investors have the protection of at least knowing they get 100% of the cash flows until they reach an 8% return.
Wow. That's a fabulous show, Brian. I really appreciate you elaborating on the structure, deal structure. I know many listeners are going to love this show. But I probably didn't ask you when you were on the show before, how you like to give back.
How do I like to give back? Well, a couple of ways. One way is I like to give back by just answering people's questions on biggerpockets.com. To me, it's like the number one way to share knowledge and give back and help people that are stuck in a situation. The other way I like to give back is myself and like 4 other guys from BP got together and formed a charity called A Hero's Home. And you can find it at aheroshome.org. And our mission is we plan to give away, all fixed up and free and clear, a house to a deserving U.S. veteran or first responder. And we've been raising money in that charity now for a few months. We're a little over halfway to our goal. And Memphis Invest, which is a big turnkey outfit here in the United States, is one of our partners, and they're going to help us find a house. And it's a day I really look forward to. So that's my other way of giving back.
That will be a big day. What a special day. That's incredible. Thanks for sharing that. And tell the listeners how they can learn more about you and your company.
Yeah, the best way is 2 ways. One would be through biggerpockets.com. You can certainly follow what I say there. on that forum. I've been on the Bigger Pockets podcast 3 times. Some of the podcast number 3, if you believe it, out of, I think they're at the 300 now. And then also through our company's website, which is praxcap.com. It's praxcap.com. It's short for Praxis Capital. There's information on there about what we do and how we do it.
Great. Brian, thank you so much for being on the show again. I appreciate you sharing your knowledge and experience and expertise with our listeners. I know they've learned a lot today, and I have as well. And we look forward to having you back on the show. Appreciate the listeners being with us today. I hope you will go to LifeBridge Capital and connect with me, and also go to the Real Estate Syndication Show on Facebook and join the group and ask questions on there, and I'll try to get your questions answered. So have a great day, and we will talk to each of you tomorrow.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.